Welcome to Crack the Money Code, everybody. I'm so excited that you're all here, that you've signed up to learn a little bit more about what it takes to be credit worthy, how you can increase and improve upon your credit score. And Winona's here to talk about that. So how it's going to go today is I'm going to introduce Winona. She's going to go through her presentation. If you have any questions or comments, put them in the chat, raise your hand at the end, post in the Q&A. I will do my best as a host and facilitator to get those questions answered. So we'll let Winona do her thing for the first bit. And then at the end of the presentation, we'll open it up for Q&A, general conversation. I'm using the webinar format in Zoom. So, and I'm not super familiar with it. So we're going to test drive it today. So hopefully you'll give me some grace when it comes to managing all the different angles of webinar in Zoom. But I'm so happy that you're here at Crack the Money Code. My name is Barbara Wallach. If you don't know me and you're new here, I am a wealth transformation expert, money healer of sorts, and a personal financial planner. I've been in business for over 3 decades and am helping women heal their money trauma, their gold trauma, learn how to let go of shame and guilt, and teach and co-create with my clients and with this beautiful group of women that come on here every week, how to create wealth and prosperity, to learn some of the practical aspects of building wealth, like investing, RRSPs versus tax-free savings accounts, just a lot of education, a lot of sharing stories, and coming together in community so that as women, we can show up as ourselves, let go of the roles and the labels that we take on throughout our lives, just to be who we are, to stand in our power, to create wealth and prosperity. Because you know what you focus on, you get. So if you're focused on wealth and prosperity and you check in every week and we have a discussion and you have a clear sight of what it is you want to achieve, then that is what you're going to start manifesting into your world. You're going to vibrate at that level. And then when you start vibrating at that level, the money's going to show up along with with clients, and your business is going to build, and you're going to feel good about it. And then as the money rolls in, we can learn about how do we make that money work harder than you do. So today, what I thought I would do is ask Winona Reinsma to come in and talk about credit and credit bureaus and credit scores, because part of learning about creating wealth is what is good debt and what is bad debt. How do we get a mortgage? How do we qualify for a mortgage? And how do we become credit worthy? And it's not as simple as it used to be. And I know Winona is going to talk about that. So let me introduce Winona here. I'm just going to go to her bio. So I met Winona through networking in Langley, and we've known each other, I don't know for how long now, 4 years, 5 years, most of my, at least that, right? And I have sent a few of my clients, my younger clients, to her to qualify, first-time buyers mostly, to her to learn about the mortgage process and how to get into their first homes. It's been a beautiful experience. Winona's really good at really hand-holding and making sure you understand what you're getting into, because there's a lot of moving parts and you're making a big purchase, and it could be so exciting that you may miss a few things that could get you in trouble along the way. So she's a mortgage and debt strategist, passionate about empowering her clients, believes in the holistic approach, which is cool, which is really in alignment with, I know, probably most of our values. And it's about, she really wants to help families improve their financial situations and achieve their dreams. So she's been an independent mortgage professional since 2010, and comes with much more experience than that. She used to work, I believe, at TD Bank, TD Canada Trust, credit union. So Winona and I was at TD Bank for 21 years, and Winona and I probably crossed paths along the way, but didn't even know it. So I know in my conversations with Winona that, after a while, We really just want to do the best thing for our clients. We want to work for our clients, not for our employers. And sometimes we get caught in the crosshairs between what our employers want us to do and what's best for the client. Hence the reason we become independent mortgage broker and an independent financial planner, because now we get to do what's best for our clients without any pressure of employers that they would put on us if we were employed by a bank or credit union. All right, so Winona, welcome, welcome. I'm so happy to have you. I'm going to make you host so that you can start your presentation. Okay. And we will take notes so you can add to that. So I'm going to mute myself and I'm going to let you take it away. All right.
Okay. So can you see do I have to screen share, right?
You'll have to screen share. Yes.
Okay. All right. Okay. So I'm just going to do that now. Let's see. We practice this. So hopefully, can you see it?
Good. Yes, we can see it. I
Awesome.
can see it. Excellent. So I'm going to mute and let you go.
Okay, well, welcome everybody. It's my real pleasure to be here. I'm quite excited to really share these secrets. And the reason I call them secrets is because we're not taught this stuff in school. And it's really quite amazing because knowledge is power in finances, is my belief. If you understand how the world of credit works, then you know exactly what to do to be in alignment to get basically what you want. So credit is one of those things where a lot of people know the just real basics, like for instance, mortgages. Everybody asks the question, well, what's your mortgage rate? But there's so much more to it. And it's exactly the same with credit. So today I'm going to explain a couple of tricks and some tips and real secrets, things that you need to be aware of so that you can get your credit to where you want it to be. And if you have excellent credit, you literally can save thousands of dollars over your lifetime on mortgage and consumer products. And I'll talk about that at the end. So let's go. Ooh. Okay, Barb. Oh, there we go. Now let me just yeah, there we go. Okay. So the question is, do you have an excellent credit history? So most people will answer if I say, how do you achieve an excellent credit? And they'll say, well, you pay your bills on time. And I actually get this a lot of times with my clients. I'll ask them about their credit before I pull it. And they'll say, oh yeah, I pay my bills on time. Everything's just fine. And then I pull the credit score and the story is just a little different than what they think it is. So today we're going to cover on understanding how lenders think, because your credit, when you're sitting there being judged, because sometimes it does feel that way, it's not a personal thing. It's really important to understand how the lenders are perceiving the report, the score, how it's put together. Then we're going to talk about how your credit history is influenced by your activities. That's where the secrets come in. And then I'll give you some rules and how to apply a strategy that can get you from point A to point B, and you can focus and get that score to the excellent levels of where it should be to open doors, because that's really what your credit history and score do. They open the doors to better products. So how do lenders think? Well, Barb, you'll remember this because the 5 C's of credit, that's been around for probably since the day I've been born. It's really the standard. It's what lenders are thinking about when they're looking at an application. And now that application can be anything from a mortgage to credit cards to line of credits, whatever the whole gambit is. So you can see that these 5 C's of credit include capacity, collateral, capital, and the conditions. Now, the conditions are the market conditions and the conditions of the loan that you're applying for. Capital, can you pay the loan back? What is your income? Collateral is the subject property. And then the capacity of how much skin in the game, what are you putting towards the application? But today we're going to talk about character. Character is your reputation and the perceived trustworthiness. Okay, because the lender is thinking the big question on character. They're asking, will I get my money back? That's what they're assessing. And it's a risk assessment. And it's not just the person that's in front of them. They've got the statistics on what the norms are across the country. They understand the market, the economy, where it's headed, and they are probably thinking about some things or have some ideas in their mind on what they need for their portfolio. So it's a lot larger than, Nancy, I've got you in front of me. Yes, I like you. You're a nice person. You deserve this money. They have to look at a broader picture. So when they assess character, they're really looking at your credit report, the details, your credit score, which I'll talk about how that number is arrived at, your personal history. Now this goes to, where do you work? How long have you been there? What type of work do you do? Now, it doesn't matter if you are a professional or a retail, working in retail somewhere. It's how long have you been there? Have you got a track record? And then when you put it together with all the other pieces, it tells the lender the story. Your history also includes, where do you live? Have you moved every 3 months? Or have you been renting in a certain location for a couple of years? You've got a job that you've been in for several years. That means you're stable. Your life is on par. You're going in a certain direction, and they know you're not going to be moving in 3 months. So the cool thing with the whole internet that's changed since I started in banking is they're also checking your references. They'll look at Google, your social media, especially if you're a business person, self-employed. Perhaps if you're renting, they'll look up Google Earth. I've had that happen a few times where a client has rented a cottage type of situation, and the lender is going back, well, I don't see a cottage on that property. Well, they've checked Google Earth. They'll look up websites and do a world search. So it's all to answer that question, who is this person? Because remember, in my particular case, what happens is I know my clients, but then I'm sending the documentation to the lender. If you're filling out an online application for a credit card, it's the same thing. They don't really see and know you personally. They're looking at the stats and the documents. So when they're looking at the credit history, you got to remember that this credit history applies to all kinds of things. You could be applying for a business loan, a line of credit. It can be for credit cards. It could be for a rental application. Your credit history is pulled for all those items. Anytime there's any finances involved, they'll pull your history. They will get your approval. You usually are signing something, even on a rental application, to allow them to pull that history. So it's like your financial business card. It tells the story of who you are. That story is really a critical part of your character as far as your financial credit and how you navigate the world of money and finances and responsible and accountability for everything that you're doing in life. It tells the story. Now, you're excellent, and there is poor, good, and excellent credit scores. You want to be in an excellent score and an excellent established credit history. So what does that tell? the prospective person that you're applying to? Well, that you've proven yourself to be a responsible borrower. And by working towards this goal, you have access to a number of products, the best products on the market, but it also allows you to carry additional debt because you're rewarded. If you have a certain score, the lenders, especially on the mortgage side, will allow you to get more money than someone who has a lower score. Most people are thinking, well, it's the interest rate, but no, it's also the capacity, the amount of debt that you receive. So I call this the golden key. And this is your credit score, that number. And it's a golden key because it unlocks more money. So what is that score that you should be looking at? Well, the minimum score that you want to be focusing on is get to 680. Now, believe it or not, if you have 679, you're not going to unlock that extra money. It has to be 680 and above. When you are getting a mortgage and it's insured through one of the insurers, it's the same number. 680 is the golden key. That's your minimum you want to attain. But realistically, your target is 780 to 875. Now I put 875 because 900 is the max. And I haven't seen too many people get the 900. But you need to, this is progressive. And all this information, it really doesn't matter if you're starting out or if you've had some issues in your credit. I have seen people pull their credit from a 500 score up to the 700s by simply being focused, understanding what they need to do, and just realizing that that is their priority. And they just budget, they work with somebody like Barb, and they know what they're doing and they head towards it. And I've seen clients that have pulled their credit around in as little as a year and a half, which is amazing. So this score of 780, like, what does that mean? How does that arrive? Now, most people, okay, you just pay your bills on time. Everybody knows that. Well, it's a little bit more than that. This diagram that you're seeing right now is from Equifax. There are two credit bureaus. One is Equifax and one is TransUnion. Now, on the mortgage side, we pull your credit from Equifax. I keep talking about we're going to be pulling TransUnion as well one day. And you pretty well have to make sure that both are looked after. What's the difference? Well, there's some cost differences. And sorry, I'm hearing. Okay, I thought somebody was saying something. So what you want to look at on this chart from Equifax is you can see that payment history, paying your bills on time is only 35% of that number. Is that a big surprise to most of you? Most people think that's all it takes is pay your bills on time, but you can see that that's not the case at all. Utilization is 30%. So what is this utilization? Well, if you pay your bills on time, but you have, say, pick a number, 5, 6 different credits, credit cards, line of credits, we call them in general trade lines, and they're all up at the maximum. So say it's a $5,000 limit and you're around the 450, sometimes you go over a little bit, you make your payments, you're using too much credit. So that goes against you. Now, the rest of it, you can see it's history, that's the long-term history, new credit, and credit mix. So the credit mix is, say you have a mortgage, mortgages show up on your credit history. They didn't years ago, but they do now. Utility bills and cell bills, your mobile phones, they show up. So if your history or the mix of your credit, say, is, for instance, say Home Depot, where you're taking the no interest for a year type of credit card that they have versus major credit cards and a mortgage, that makes a big difference on your credit history. So you can see it's a lot more than just paying those bills on time. And that's the key thing that you have to remember. You got to look at the full picture. And that's what the lenders are looking at. They want the full picture. And they need to do that in order to assess, are they going to get their money back? So this is also from Equifax. And why I'm showing you this is, where did I get that number of 780 from? Try to get to that number for your credit score. Well, if you look at the orange box in the middle, this is why. You can see that they call it examples of score shock factors. So if something happens in your life, now it could be something great, like you go on a trip and things are, I had this happen with a client. They went on a trip, they went to Europe, things were a little bit more expensive than they anticipated, but they wanted to have a good time. They had the money at home. They had only one credit card with them. So they started using this one credit card, and it was a sudden use, just like very large balance and utilization change. And they went right up to the limit. Well, see, with that kind of situation, when you're moving from zero utilization to suddenly 90 or 100%, your score can drop over or up to 100 points. Now, what if that happened just before you decided you were going to move or apply for a new mortgage, and you were at 680, and suddenly because of this one-time thing, it drops below 600? Like, that's a huge problem. So that's why you want to go higher. Once you get to 680, you're on a roll. It's just a matter of focusing and making sure that things are in place to get to those higher scores. So how do you do that? Oops, hold on here. So we've covered so far that paying your bills is not enough, and what the lenders are thinking, and how your history influences your activities. So let's talk about some of the rules and really what's important. Apply a strategy to help you improve your score. Well, here's the secret strategy. This is what you should be teaching your kids. And it's as simple as 2 times 2. And originally when I learned this, it's 2 times 2 times 2. But I put 2,500, and I'll explain what this means. So in my world, we call the products trade lines on a credit history. Trade lines are a credit card, a line of credit. Now you could have a loan, you could have a lease that shows up as well. They're products where the balances are fluctuating. So a mortgage is usually set, it's on your history, and that's really good. But in most cases, when people are trying to improve their credit, they may or may not have a mortgage, but they'll want something that they can actually work with. And these are the trade lines with running balances. So what does that mean? It means like your credit card, your limit might be $5,000 and your balances, you can use it and pay it off, use it, pay it off. It's something that's fluctuating. It's a trade line. Line of credits work that way as well. So 2 products is what you should be working with. 1 is not enough. You need 2. Now, it can be a loan and a credit card. It could be 2 credit cards. It could be a line of credit. It's a really good idea to have major credit cards. Okay, that's key. It'll work with, like, is there a Hudson's Bay credit card anymore, Barb? I don't know. But those department store ones, you're better off have the major credit cards. You need 2 of them that are active and being used on a regular basis. You need, the second two is 2 years established history. It has to be a solid 2 years where you're using those trade lines, where the activity is showing you're demonstrating your credit worthiness. That's the key. If it's only a year, it's not long enough. I had one situation where a client was reestablishing their credit, and at 17 months, they had built a really good history, but another credit provider had offered them a better credit card. It was a better rate of interest. They didn't have to pay them the fees. So what they did is they closed the other card and got the new one. Well, they just ruined their 2-year history on that card. A closed card is not going to cut it. It has to be 2 years active activity showing up. So 2 products, 2 years. Now, the reason I have the 2,500 is that is the limit goal that you should be looking at. When you're first starting on, especially a credit card, it's going to start at 500, even a line of credit, 500 or 1,000. Just that's where you start. Anytime they offer you a higher limit, just take it. You want to build those limits up high, at least to 2,500. Literally, somebody that is just like someone that's in their mid-20s that are applying for a mortgage, and they've got 2 cards, it's 2,500, the history's there, it's golden, everything's good. But the key to this is, it's not that you're using that limit to 2,500. Remember the utilization? You do not want to be living on credit. If you have a credit card, even if you pay them on time and they're all at those balances, lenders will look at it. Oh, this person is living on credit. You want to avoid that. So the thing you want to do with your limit is make sure that you are well below the maximum. Now, if you happen to be in a situation where you've got a couple of credit cards, and it's near the limit, your first goal is to get those balances, bring them down to 7,500, then work on bringing them down to 50. If you have one credit card that is maxed and you've got another credit card that isn't being used, then make sure you stop using that card with a high limit. And even if you have to take a cash advance or money from somewhere else and bring it down and use that second card. There's different ways to navigate that depending on your situation. My client that went on the vacation, they did happen to have their mortgage going through. They were in that in-between stage where the lender could very well do another credit check. So when they got back home, they actually took a credit advance from their second card and paid down the first card. So it was at least a 50%. So there wouldn't be an issue. And then shortly thereafter, when they paid it off, they had the money for it. They just didn't have it with them on their drip. Okay, so that's the strategy. 2 products active for 2 solid years. Obviously, no slow payments, have great history, show that you pay it off. Ideally, that you're paying the balance off in full if you can. That's when you're building up. If you've already got credit issues, then what you want to do is you just want to start chipping away at those balances and getting them down. Now, while you're doing this through this period, you need to also monitor your credit report. And what I advise is that you should order your full report from both Equifax and TransUnion each year. Do that until you've got your score, you know that everything is good. Your score is at over that 680 number, and that you've checked to make sure that there's no issues. Depending on your situation, some people do buy those monitoring systems. There's ways around that, but you should do it at least once a year. And I'll tell you why. There is something that's happened this last year. Equifax had a major upgrade to their credit reporting system. It's actually a really great upgrade. There's a lot more information showing up. So I really advise all of you to be ordering the report, because you want to make sure that during that massive shift and upgrade that there's no errors showing up. I had this happen to one of my clients. They had excellent credit. I've been working with them on a pre-approval process, so I knew what the credit looked like. And then I happened to pull their credit after the upgrade, and there was an error on it. So they were able to quickly contact the proper parties, have them correct it, get a letter, so it didn't affect their mortgage process. So check for errors. And the other thing is, if you're somebody that happened to take advantage of the COVID deferral, you just want to double check, make sure that that's been reported properly. You should see on the report that it just says deferred. You know, those reports are done, human errors are made, and that's what you're looking for. Now, the other thing you're looking for is you can take a look at who's pulling your credit, what's showing up, and it really gives you a good sense of where you are. So you should be looking at that report in detail. And there's lots of information on how to read it. You want to see ones. On each trade line, if you see a row of ones, you're golden, because that means you're paying your bills on time and it's reported on time. So to monitor your score, there's lots of different apps you can get. You can get paid services, but you don't really need to do that. I use my own for my company, because I'm under Mortgage Alliance. We have an app that's called Mopolo. So my clients can just download this. They enter my name as their mortgage broker. And I use this myself as well. It's really easy. You just go in and I go, bang, there's my score. Now, you want to see that your score is going up. And then you want to just monitor it to make sure it stays up. If something suddenly changes and you don't know why, you want to find out what's going on. Okay, so lots of options there, super easy. Now, when you do this, it doesn't affect your score at all. It's a soft pull. I can check my score every day if I want, and it's just that easy to do. And it's worthwhile because it's also the feedback. Like if you're really focused and you have to bring your score up, and then you can see it going up, that's your gratification that you know that your effort is really working. So that's a valuable tool to use. Now, here's some tips to make the whole process easy. Automate. Automate is the lifesaver in this hectic, crazy world. You can set up at your bank to automatically pay your utility bills, to automatically pay your credit cards. You can have your credit cards coming. In some cases, some credit cards, they'll debit your bank account. You can have all of that set up. It's just something that's absolutely worth doing because, you know, life happens and we're all way too busy. Sometimes people think that, well, it doesn't matter if I make the payment a week later or something. Well, it can make a huge difference. I recently, again, had a client. Everything was great until I pulled their credit history. And they had a TELUS bill that they didn't realize that they were prepaying it. They had 5 times they were slow in their payment. Okay, so on their report, they're seeing 1s and then 2s. Now a 2 means you're past due and you're making the payment the following month. And they had 5 of them. When their mortgage went to the insurer, it was declined. The insurer declined it because of those slow payments. It is critical. by automating those monthly payments, you don't have an issue, and you know it's always taken care of. So here's kind of a budgeting suggestion, a strategy that can work really well, is if you have one of your major cards, and it could be a line of credit too. So one of the trade lines, you use that for your fixed monthly expenses. And then just make sure that you have automatic payments so that everything is paid before the due date. And the reason I say before the due date, you have a couple of approaches. Now, you get your statement, and there's a statement date. And then it says you owe X amount of money, and this is your due date. Well, the thing about that is if you're doing it manually and you forget and you pay it a few weeks later, you're going to run into a problem. By paying it before the due date, number one, there's never going to be a problem. If something happens, unexpected, you've got a little bit of time left to fix it before the due date. And then also, if your balances are currently near the limit, you are paying it early so that the balance is lower before the reporting date to the credit bureau. Okay, so it's hard to give you a definitive number on that because every creditor is reporting differently. Some do it twice a month. There's different dates. By doing this on the statement date or early, at least you've got the advantage on your side. So the first card, let's say you're using 2 credit cards as your strategy. So the first card you use for your fixed monthly payments, you set it and you forget it. You've got those payments every month that you do. You put your pay in whatever account separate if you need to do it that way. Now, the second is for those irregular statements or expenses rather. Now, those expenses like food, right? You may budget $400 a month, but one month you're using less, whatever the case may be. Put those on the second trade line credit card. So that second credit card, pay it with the credit card and then go home and pay it off right away. So you're showing activity and you're paying it and you're showing that you're responsible. You're not living on the credit. So that is how my clients fix their credit in a year and a half. And they brought their score up really quick because they just did that diligently. They stuck to their budget and it worked. It was awesome that they did it that fast. Now, this is the balances. This is what I was referring to. You can automate it. If you're going to do it manually, maybe for some reason you're paid irregularly or something is a little bit different and you have to pay manually. When you receive your statement, pay it right away. And again, the advantage is you're dropping that balance. If you're carrying a balance, you're bringing it lower. So at reporting date, it's showing a lower balance. Now, here's the real trick with if you're carrying a balance. You need to limit your usage to 35% or less. Now, I got that number right from Equifax. I was always told when I worked in the bank is as long as you don't use more than 50% of your limit, but it's actually 35% of your credit limit. So this is really an important key if you're helping your kids establish their credit. Get them the credit card and then let them know like 35%. Hopefully they're going to pay it off monthly, but if they have to carry it over from a month for whatever reason, 35% is the target. And then that includes, by the way, credit cards and line of credits. So if you do that, you're going to get to those upper limits on your card. So the last point is use your credit cards for planned expenses only. This whole world is, this shopping therapy. Now, I guess with COVID, we are now shopping therapies online. Sorry, but You know, that's just a marketing slogan. It's a gimmick to get us out there. What does that really do? If you're trying to fix your credit, you can go out there and buy something, come home, and I don't know what you're like. I come home and I feel guilty if I bought something that I didn't plan for. If you're focusing on fixing your credit, shopping therapy, out the door, use your cards for planned expenses, and that will feel empowering. And especially when you're checking your app or watching your score go up, you are going to feel incredible. You are in control. You understand what you're doing. And really, debt is the one thing and the only thing that we can really control. I think with COVID, once COVID hit, I went, boy, I used to always say this, you can only control your debt. Well, with COVID, I go like, yeah, this really rings true to me now. By using the strategies I've explained, you can get to excellent credit. It doesn't matter where you are in the whole gambit of a low score up to the higher ones. If you use those strategies, you will get to the excellent credit. And why is that important? It's important because that credit score is one of the tickets that will save you thousands of dollars. And here's why. You have access to the best products with favorable terms and conditions. You'll access more money. Now that you go like, well, why is that important? When you are applying for a mortgage and having more money makes a big difference. Remember that with the mortgages, it's a better interest rate than if you're going for loans or credit cards. If you can get a higher amount of mortgage money, it's going to make a big difference. You can obtain credit when you need it. Basically, it's one of those things that sometimes sounds counterproductive to someone that perhaps is younger or doesn't understand credit. They think, oh, credit, I can use it. Well, really, when you're using your credit and then you apply for a mortgage, you're really showing that you don't live on credit, that you are responsible with credit, and you're going to pay that lender back. So by protecting your credit history and making sure that it's in the excellent range, when you really need credit, you'll be able to get it. And that's the key about it. You want to be able to get it. Don't be frivolous with it. I'm not saying you are, but some people, they, oh, you know, shopping therapy, I'm going to go get this, get that. Well, it's okay if you have the money to back that up, but sometimes we get into this trend or a downward spiral and it gets out of control. You don't want to do that. Over your lifetime, getting preferred products means you're going to get the access, the interest rates, and the better products that will save money in a number of different ways. And the other thing, it's also will give you access to leverage for investments and wealth creation. That it just helps you in so many ways. So I've said a lot of things. You go like, well, Winona, show me the proof. Well, you know, I had a great customer and we went through all the education and he was being told, oh, you should just go to a bank. What's this mortgage broker? No, you go to the bank and deal with them. They'll give you the money, blah, blah, blah. So he was going like, well, my friend keeps telling me to go to this bank, right? And you tell me this is a better option. You say I'm going to save, but like, how does that really work? No, okay, well, that's a really fair question. Let's take a look at what the difference is. Now, mortgages, everybody knows about the interest rate, and that's the easy thing to compare. But what about when you have to break that mortgage and pay a penalty? 6 out of 10 Canadians break their 5-year mortgage term. So we did a comparison of the bank that his friend was telling him and the option they had because they had excellent credit. They had access to the best mortgage in the market. It happened to be equal interest rate, but the features and conditions were better. So I showed him the proof. I said, that lender that you're talking about, when you, in this example, I did exactly the same statistics. It was a $500,000 mortgage, and they were breaking, in this example, they were breaking the mortgage with 3 years left on the 5-year fix. The penalty on the other lender is $25,009.90. That would have been the penalty. And that's from the lender themselves. The better mortgage option, the one they had access to because they had a high score, they were in the high 80s or 800s rather. This is what the penalty would be. And I'm looking at Barb's face. Yeah. So now do you know why I'm saying that the excellent credit can save you thousands of dollars over your lifetime? If you don't have good credit, you're not going to get access to the second lender because they only take clients with great credit. Now, there's other factors involved. You have to have the income, you have to have the capacity, all that has to be there. But if you have a score of 580, you're not going to get option B. I wouldn't even try sending the application there. So if you have any questions, if there's anything I can help you with or give you a second opinion, or you have questions about these strategies, give me a call. I'm only too happy to help. I do mortgages, like Barb said, mortgages in your best interest. I work for my clients. I can take you to a wide variety of lenders, and we'll work through the pros and cons, because it's all about leaving the money in your pocket and not throwing it away. But your credit is the first place to start. Thank you. It's been a real pleasure. And feel free to contact me if you have any questions or you want to chat.
Wow. Thank you so much, Winona. That was so much information in a very short amount of time. And we have some questions.
Okay.
So maybe what we can do is I will ask you the questions for now. And then if you have any questions, ladies, maybe raise your hand or pop them in the chat box. So, yeah, we answered Sabina. I had the question is, how do we find out what our credit score is without getting dinged? You had answered that. You can you can use the app.
Yep.
So that's cool. And then Noella asked, how can you improve your credit score with no credit card balance?
It's the activity. Okay, so say you have a credit card and it's got, well, it doesn't matter what the limit is, $1,000. Okay, so what you're doing is you're using the credit card. Say I go buy my groceries and I use my credit card. Then I come home and I transfer the money from my bank account to cover that credit card bill. So it's the activity. So on your report, it will show that the balance is zero because you pay it off. Your limit is $1,000, and you will have that score of 1, which means that you are paying as agreed. And that's what, like when I see a report and it's got R1s and it's zero balance, it's like, then the score of like 700 or higher, and it's like, whew, good credit. But it does need to have those 2 products, and they have to have the activity.
Excellent. Thank you. Next question is from Janice. She goes, she buys everything on her credit card, and she goes up to 50% limit, but she always pays it off before she even gets the statement. Is that building good credit?
Yes.
Or is that considered living on credit and hurting her credit score?
No, if she's paying it off, if you're paying your bill off every month down to 0, that's perfect. Now, like having it up to 50% and paying it off months, your score, you keep doing that, your score must be good.
I have to check it out, Janice, and pull that
Yeah, yeah.
Polo app. Cool.
Yeah.
Connie says, thank you very much, Winona. Really good and informative. She appreciates you. Angela asks, what if your spouse has been the main earner and taking care of the bills, and now you're going out on your own? How does that impact one's ability to apply for a mortgage, for example?
Well, on a mortgage, the thing is, there is, in our world, mortgages, there are situations that life happens. And if this is going on, your own divorce, whatever that may be, it could be business, it could be a bankruptcy. The lenders have hearts in the sense of that happens. We see that unfortunately too often. So what happens is, if there was an issue during that situation, I see that quite a bit, a divorce, and then the finances go because everybody's busy on that. What happens is, we look at the bureau, what have you done since that crisis situation? So as long as you have the income and then you reestablish your credit, it shouldn't be a problem. Now, it might not be right away. It's hard to give you an exact answer because it really depends. Like, I've seen everything. I've seen everything from somebody coming out, but they've got a good job and they just get their own credit cards and it's fine. And I've seen the other extreme where it's totally blown up their credit and they don't have the income and they have to rebuild. Either situation, it's just about reestablishing and having the income and having the good credit. And yes, there are lots of people that are in that situation that get a mortgage after, but you have to have the other pieces and the income to support it as well.
So, Winona, I may have gapped on hearing you answer this because I was checking comments, but when you're self-employed, how many years do you need proof of for income?
Yeah, self-employed has changed dramatically in the mortgage world. And we haven't gone through the full 5-year cycle where people are really realizing it. And, it's like, I still get a number of self-employed people and they go, what are you talking about? Okay, so self-employed used to be super easy. We had programs called stated programs. And basically, just to keep it simple, it basically meant that we could use your gross income. That's all changed. It is now based on 2 years. It's your net income. So all those lovely deductions, which is a benefit. I mean, self-employed, we work hard. We all know that we work more than 40 hours a week. We work weekends, right? And why would you do that? Because you're building your business. You've got supposedly freedom, but it's like Barb and myself. We do it so that we can help our clients and not have an employer say, no, you have to sell them this and that. But now after, like, we're writing off everybody that's self-employed, you've got expenses you write off, and then you're paying taxes on the net income. Unfortunately, in mortgages, you can only use the net income. Okay, so that is really an important conversation to have with, I'm going to say, a mortgage broker or somebody in a bank that really has the time to discuss this in detail with you, and your accountant.
Yes.
Okay. Sometimes it's going to be worth, and these days it's a case of you're going to be getting a mortgage where you're going to be paying a higher rate of interest because the offset, it might just be better than paying your CRA taxes.
Yeah.
It's, the other thing is, the mistake I see sometimes is people will go from employment, full-time employment, employee status, and incorporate suddenly. Well, you have to have 2 years established history. Now we're talking tax years too. All right. So when you make that kind of a change to your tax situation and going into self-employment, it's really important. There are a number of other things as well. If you are claiming taxable dividends all of a sudden or one random year, that can be a problem. Like there's a multitude of issues in self-employment. The other thing to be aware of, and this is kind of, I'm bringing it up because of the COVID situation, is if your income dropped dramatically, well, the lender might be looking, okay, 2 years ago you made 100,000, but now this last year you only made 50. They may not use to your average. So there are all these things when you're self-employed that are very different from your neighbor who's telling you that they got the rate of 1.39. It's entirely different. So I advise people that are self-employed to discuss it with someone that can really help them navigate that. And it's working with your accountant, the mortgage broker, and go, okay, this is the world as lenders see it. And now you have to make the decisions on what's going to work best for you within that it's a new world. Everything's changed for self-employed.
Mm-hmm. So each individual is really unique. I know when I work with my financial planning clients, quite often I will try and confer with the accountant. And I always advise them to, yes, we want to show low income so we don't have to pay as much in taxes. But at the end of the day, when it comes time to buying our dream home or our second home or whatever it is we want, we have to show that we are earning good money. And we probably are earning great money, but we are not showing it.
Yeah, exactly.
All kinds of write-offs. So it's a bit of a balance,
Yeah.
So something, if you got something like that in your future, definitely prepare for it. Consult with a independent mortgage broker, talk with your accountant, talk with your financial planner. It's good to have a solid, holistic team together working on your behalf to get you to realize what it is you want to do. So thank you, Winona. Great answers. Everybody's loving the information. So Tara is asking, so is it better to pay off a purchase on a credit card when you get home right away, or at least let it show up at the end of the month and then pay it off? Or does it really matter?
Well, if you let it show up at the end of the month, I'm going to assume what they mean by that it shows up on the statement. It doesn't really matter if they get their statement. It's going to show up on the statement anyways, because you're going to have to get, so that it doesn't matter. Where if they mean let it roll over, that they don't pay it off in full, no, you don't want to do that, because then you're paying interest. So I quite often, I'm kind of manic with, I hate owing anything. It just drives me nuts.
But life happens, right? Sometimes you do carry a balance. And so that would lead me to my next question that I was curious about is it advisable to sort of a two-part question? And I know we're a little bit over noon. Hopefully you can stay. If not, I will send the recording out to everybody so they can hear all the answers to the questions that I've got here. Is it okay to use balance transfer checks? Because sometimes a credit card company will say, transfer your existing balance from another credit card over to here at 1% for 6 months versus paying the 19.99%. And or is it okay? Oh, balance transfer. Oh, and is it okay? I almost lost that question. To go from say you're with RBC and you've got one of their VIP cards and it's got $100 fee a year and you're getting charged 19.99% and something's happened and you've got a balance owing on it. Will it affect your credit rating if you ask them to switch that balance over to a low interest rate credit card, with the understanding that we still need that 2-year history, but say we're already past that and we just want to try and lower our interest costs?
Okay, so the balance check is not a problem. It just shows up that there's a balance on the new credit card. It's only an issue if the limit is low or close to that amount you're transferring. Okay, but you know that yeah, how you access the money on a credit card, be it a cash advance, the check, or just charge, that doesn't matter at all. If you haven't, if you've got established, like, you know, like I have a lot of different cards and a lot of them are just zero or just sitting there.
Yeah.
You know, if I were to switch to another card, that's not going to change my score. That's not going to be a problem.
Okay.
It's only if you're, you know, like if you're brand
6 months.
brand new, like, or having to rebuild, then you've got to be careful that you have at least two. So just to clarify that, my client that closed after 17 months, they had all their cards closed because they went through a consumer proposal and they were reestablishing, starting all over. Then closing the one card that's when it makes a difference.
Diane is asking here, maybe you mentioned, but if you have a credit card that you're not using very often, is it okay to leave it dormant? I think you already just sort of answered that. Or is it better to cancel it? I'm assuming it contributes to the 35% or less utilization. And I think you've already sort of answered this, Winona, in that, you know, if you've already got an established credit rating and it's solid, then that's not necessarily a big deal, correct?
No, yeah, that's correct.
Okay.
Yeah.
Now, Ray Joan is asking something about the PowerPoint you showed, I think, after the tips. I'm not exactly sure what you're getting at, Ray Joan. Are you looking for this?
After the tips, the one thing?
The one thing. Go to the next one, Winona.
No, it had not a wheel, but I think not that one, because I have that.
There's
going to be a replay.
Okay.
So you can,
okay.
I'll send it out to you. Don't you worry.
Thank you. Thank you so much.
Yeah. Okay, cool. Thank you. I think that is it for questions for now. If anything else comes up, oh, Clarissa. We have another question. You're welcome, Tara. Great questions, everybody. If you have one credit card you use, personal line of credit, which is at 0, and one credit card which is uninsured, I'm about 6 months into self-employment. I don't use my line of credit, just the insured and uninsured credit cards, which are paid off by the due date in full. Can I increase the credit score by paying off when I get home? Clarissa, do you want to maybe go on your mic and just ask the question? I can't. Hold on. Attendees, Clarissa. Oh, it's not even allowing me to do anything. All right, so let me see if I understand. So you've got a personal line of credit, which is zeroing. You've got a credit card, which is uninsured. You're about 6 months into self-employment. You don't use your line of credit, just the insured and uninsured credit cards, which are paid off by the due date in full. Can I increase the credit score by paying off when I get home after a purchase?
Yeah, I'm not 100% sure. So let me answer it this way. The point is you want 2 active trade lines. It can be the line of credit that you're saying you're not using, or 2 credit cards. That's fine. So the fact that you have the line of credit not using, that's okay, as long as you got 2 other cards. And that, you know, if you're charging something and then coming home and paying it off, that's activity. And the point of the activity and paying it off is that you've got the balance 0. You're showing the lenders that you're using it. So there's the utilization. You're making the payments on time. So yes, that's going to contribute to a better score.
Did we get that right? Clarissa, I reclaimed host power, so I made you able to talk if you need to.
Oh, okay.
Clarifying question.
Yeah, no, that helps a lot. I want to keep my credit score high as I go through this transition for myself and make it better. So I was super impressed and happy with the presentation by both of you today. Thank you so much.
Oh, you're welcome.
And I just wanted to see how I could increase my credit score even more, because when I have talked to banks in regards to planning for possibly a mortgage in the future, um, they've been very unfavorable in regards to self-employment.
Mm.
Yeah.
That's unfortunate.
They generally are in the sense, okay, and we're talking very general, okay? So, it depends, like when I hear that, I go like, it depends on which bank you went to. It depends on what kind of business you're doing. It depends on, see, the thing when it comes to income is that for us on a personal side, that you've got money coming from here, money coming from there. And I've had often my clients say, oh, I make lots of money. And then it's like, okay, what's the source? Barb's laughing. What's the source? Well, one is just a contract that I pick up here and there. There's no guarantee of anything. See, lenders are looking for guaranteed income. So a good example is there are a lot of people making a lot of money on Airbnb. Well, guess what? A lot of lenders won't use Airbnb because it's not guaranteed. There's also a lot of other issues behind that, which I won't get into. If you have Airbnb, give me a call. There's nothing wrong with Airbnb. I've heard that you can make like 50 to 70% more income. But, the question is going to be, well, do you claim it? It's the same as, do you have a rental suite? Do you claim it on your taxes? Like there's that whole issue as well. So income, what you're collecting in income and what is eligible income are two different things. When it's self-employed, you need a 2-year track record. And like I said, that track record, what they want to see, what they're looking at is what's the type of income. Is it steady? Is it growing? Are you building a business? Is it something that they recognize? So that's really individual. If they're not favorable, you might just be talking to the wrong person.
So what I recommend, as always, is have a plan, right? Work with somebody who can help you set a plan in place. Talk to Winona. I know she's always open for a conversation around how you can, put a credit building plan together. Thanks, Angela. We'll send out the replay. On my website, barbwallick.com, I have a sort of a mini course on how to reset your financial plan for the year. And there's about an hour-long webinar on there where I talk in detail around the different types of debt, different debt repayment strategies. I don't talk about credit, but you can take what the learnings from there and the learnings from here and maybe put in some strategies if you're in debt. No guilt, no shame, right? We don't know what we don't know. We're not taught these things in school, and it's never too late to learn and to put a plan in place. So between Winona and I, or whoever you choose to work with, we're open to having conversations and getting you on the right track. That is really zero debt. Yes, good. As long as you've got good credit rating and show that you can take on debt and repay debt, that's a cool thing. So go to the website if you want to get the little mini course, book a call with Winona if you want some individual attention. We're all unique. Banks sometimes are really loosey-goosey during certain times of the economy where they will give away money for free, it seems like, and then a crisis will happen. Like in 2008, 2009, we had the financial crisis, and I was working at RBC back then, and I was doing credit, loans and mortgages and stuff like that. Trying to get anybody approved for anything was almost impossible. They just locked down, and unless you had perfect everything, they weren't lending any money out at all. So there's always moving parts. Things always ebb and flow. in the economic cycle, in the stock market cycle, and in the world and in our own lives. So being prepared and having a plan is always your best option. So from that, thank you so much, Winona,
You're
for
welcome.
being with us today as our special guest. Lots of great information. If you have any other questions, let us know in the Facebook group. If you're not in the Facebook group, join the Facebook group. I'm sure Winona's in there now, so she can always answer your questions if you have any there. I will send out the replay to you. Once it's processed, I'll edit it a little bit. And then I'll see you all next Wednesday for our open forum. Then the following Wednesday, the 16th, I believe it is, Wednesday, I have another very special guest coming on, Nina, and she's going to be talking about the feng shui for abundance. So we're going to shift our focus a little bit to the more of the energetics around creating abundance and creating flow and allowing that money to come into our lives. So just a totally different perspective altogether. So I hope you'll join us then. I will get that up and running and the link out for you to register for that as well. So everybody says, thank you very much, Winona.